On July 31st, there was a historic intervention in the yen market by the U.S. Treasury, and I had Steve Hanke, professor of applied economics at Johns Hopkins University, on to discuss this historic move. The U.S. hadn't intervened in the yen market since 1998, the Asian financial crisis. And you can watch the video down below for Professor Hanke's analysis on what happened and why the U.S. did it this time. There was a section during that interview in which Professor Hanke was talking about his experiences firsthand in dealing with several of the currencies during the Asian financial crisis, especially and particularly the Indonesian rupiah, in which he was very intimately involved. And he's going to be talking about how he also stabilized a few currencies in Eastern Europe prior to the Asian financial crisis. So we're going to expand on that particular chapter of the interview in a bit more detail today, because a lot of viewers, a lot of you watching the show have requested in the comments that we do so today and give a more detailed overview and history lesson on what the Asian financial crisis is all about, so we can understand whether or not it can happen again. Professor Hanke, welcome back to the show. Good to see you. Thanks for being here.
Well, David, great to see you. Great to be with you today. It's even better to have viewers who are requesting elaboration on points that actually are worth elaborating on.
It was funny. We had a 50-minute conversation. The part about the Asian financial crisis was maybe less than 10 minutes, but that's what everyone was commenting on. They wanted more elaboration on how it happened, why it happened, and particularly your involvement with the Indonesian government at the time to try to stop the collapse of the Indonesian rupiah. Of course, your plan, the currency board, was not put in place, and you'll explain in a bit more detail today why. Comment down below what you'd like to see next, and we always take viewer comments and questions and submissions at heart. Before we talk about what happened in 97, let's just talk about the current situation. You had told us last time that the yen intervention, which caused the yen to appreciate back to 160, it was at 164, it appreciated back up to 156 to the dollar. You said that was going to be a dead cat bounce. You would not be a buyer of yen. In fact, you would be a seller of yen at that level. You turned out to be correct. It's now fallen about halfway back towards 164. It's now at 159.58. So the question is, what was the point of this intervention if the yen didn't stabilize? And I guess broadly speaking, now that we're on track to retrace the previous level before the intervention, are we expecting another bigger intervention? Otherwise, again, what was the point?
Well, the point is to try to stop the collapse of the yen, and you can see that. So the point was to try to stop the collapse. So there was a dead cat bounce, and I think they'll simply be the short sellers are still in there. Some of them got out, and then they piled back in. So I anticipate that they're going to, if they want to keep it stabilized, they'll have to intervene again. That's my guess. I don't think it's got I think it's an unstable equilibrium right now, as they say in economics, and the shorts will keep pounding it, and it will go down, because the only way you can change the course of a currency is to change the fundamentals, and they're not changing the fundamentals of anything. So
let's just recap for the audience why the U.S. is so concerned with the collapse of the yen. And I want to just show you what happened here. On the same day that the yen appreciated, the S&P also went up and gold went up. You see that?
Yes.
Yeah, the blue line is gold, and the S&P 500 is a green line. Both went up on the same day the yen went up. So clearly, U.S. markets and to accept global markets care.
Yeah, the U.S. markets obviously liked it. For the life of me, I don't exactly know why. But again, the fundamental picture is, and the key thing, you have to ask, well, why has the yen been weakening? Why is it getting weaker and weaker? It's getting weaker and weaker because the money supply is growing very slowly in Japan. It has been for a long time. And as a result, the nominal GDP, the real rate of growth plus the inflation rate, it's very slow, the nominal GDP growth. And if you have very slow nominal GDP growth, you're going to have weakness in the currency. That usually is associated with weak currencies. Weak economies, which are weak because of weak money supply, are result in weak currencies. So that's been the weakness, and none of that's changed. That's all remained the same. The only thing that changed is that in an unusual move, as you pointed out, David, the U.S. and the Bank of Japan jointly intervened. Now,
Yeah.
the Bank of Japan had been intervening before the joint intervention, but it wasn't doing anything. I mean, they just don't have the firepower to intervene. So they got the U.S. involved, and the joint intervention had, I think, more credibility, obviously, than just the Bank of Japan alone. You had an international partner tagging along with the Bank of Japan, but I think they're going to end up having to intervene again if they want to keep the thing stable.
The fundamentals, if you look at the long-term chart of the yen, I mean, despite maybe several attempts at intervention in the past where you had dramatic upswings in the yen, the longer picture, the bigger picture is that the yen has continuously depreciated over the last 5 years. Is that the trend that you expect to continue, given the fundamentals of the country, Professor?
That would be the trend, given the fundamentals. And the key fundamental is the fact that the money supply is growing at a very, very slow rate, a rate that's much slower than a rate consistent with hitting its inflation target of 2%. Of course, its inflation is below 2%. It's below 2% because the money supply is growing so slowly. So that's one factor. That's a monetary factor. The fiscal factor is one that the new prime minister is goosing the economy with more spending, especially spending on defense. So the deficit gets bigger, and they've already have the world's highest debt to GDP ratio for an advanced economy. So that's another reason that it's negative for the yen. A bigger fiscal deficit and more debt being piled up, that's a negative for the yen. And the slow growth in the money supply resulting slow growth in the economy, that's another negative.
Before we continue with the video, let's talk about your most important asset, your personal privacy. Now, you've probably never voluntarily handed your personal information to a data broker, but they have it anyway. Your name, home address, phone number, even details about your family are collected and sold to whoever is willing to pay for it. That's why today's sponsor, Delete Me, is a service I use to cut that down. Setup takes a few minutes, and after that, their team does all the work. They find where your information is listed, verify it, and submit removal requests to hundreds of data broker websites around the internet. Then they keep checking because these listings tend to come back. Since June 2024, they've been reviewing my listings, and my most recent report showed 335 listings reviewed last month alone. Scan the QR code here on the screen or go to joindeleteme.com/DavidLin, link down below, and use the code DavidLin for 20% off. Take back control of your privacy today. Now back to the video. I think, and if you take a look, I'm going to add one more variable to this chart here. This is the 10-year U.S. 10-year Treasury yield. It also went up on the day of the intervention. So let me just zoom in a little bit. I know this is a bit messy. Let me take out gold. Let me take out the S&P. And you can start to see a little bit, this is late July 31st. The 10-year has already been moving, and it continued to move up a little bit more. I think one explanation is that the intervention of the yen market by the U.S. Treasury signaled to the markets that the Treasury was willing to directly intervene in foreign currency markets in order to in order to stop the 10-year yield or the 30-year yield from climbing higher. Because the worry here is that if the yen collapses, the yen carry trade would unwind, investors worldwide would sell treasuries, and Treasury yields would go up even more. So this is an indirect form of yield curve control. Does that make sense to you?
Yeah, that has been one rationale that's been put up for the joint intervention and the U.S. involvement. That they're worried that now let's say what is the carry trade? The carry trade is you borrow in yen because it's so cheap, and you think the yen's actually going to get weaker, so you'll have to be paying back the yen that you borrowed in a weaker currency. So you'll pick up some gain just because the yen that you borrowed in is being paid back in a weaker yen than when you borrowed. But the big thing with the carry trade is the interest rate differential. You borrow at very, very low interest rates in yen, and then you reinvest those funds that you've borrowed in higher yielding assets, whether the U.S. and the U.S. dollar is one of them. The carry trade flows into the U.S. market. So, in a way, it provides liquidity and funding not only for U.S. bond market, which you've got up there now, but also the stock market. But the big concern was the bond market, that somehow if the yen really got into crisis mode and people started thinking about liquidating their U.S. treasuries, that would cause a problem because the price pressure on the U.S. treasuries would be down and the yield would be going up, of course. So that's part of the, shall we say, the scenario that they put up.
Okay. So given that you think the U.S. is likely or willing to intervene again, do you see an end to the rise of the long end of the yield curve in the U.S. for now, the 10-year and the 30-year? Do you think that
I think there's so many other there's so many other factors involved that are probably more important. And I do think, for example, the 30-year, I think that could easily go up, with just what's baked in the cake right now. The war in Iran, the Gulf being shut, the Red Sea being shut off by the Houthis, all these disruptions caused by the war, number one. Number two, the inflation genie is still out of the bottle in the United States. So that's a second thing. And just the general fiscal problem that the U.S. has with its increased deficit that has to be funded by the issuance of more and more Treasury paper, whether they're Treasury bonds or Treasury bills. So all those three factors combined point to the fact that I think that the 30-year could at least go up 50 basis points from where it is now.
Wow. What happens to markets, stocks, precious metals, so on and so forth, if the 30-year goes up to that level?
It obviously is a headwind for the stock market, and it's also a headwind for precious metals, which incidentally look like gold is finished its consolidation and it's going up.
Yes.
And the secular bull market in gold that we talked about many times on the program, and I happen to be on board with the secular bull story in gold, and I indicated, I think the first time I ever did it in public, you twisted my arm so hard that I had to confess that I thought it would peak out at $6,000 an ounce, which I'm still holding to.
Yeah, you were almost right there. 5,500 was the top. So we can come back to gold another day. I want to ask one more question about present-day Japan, and then I want to go back to the Asian financial history. You said that the Japanese M2 money supply growth was slow, but okay, fine. And also the Japanese inflation rate is relatively low compared to the West. I think it's like 1.7% in June 2026 on an annualized basis. So why doesn't Japan just print more money? Wouldn't that backstop the yen collapse and they can also
Well,
kind of afford to because their inflation rate is so low?
yeah, yeah. Well, they should be all the narrative, by the way, in the press. So the viewers will be confused because if they're reading the financial press, the financial press says that the monetary policy is very loose in Japan, and they say that because they look at the interest rates, and interest rates are very low in Japan. So they say that's loose money. But monetary policy is not about interest rates. It's about the money supply, changes in the money supply. And if you look at changes in the money supply, we're growing at just a little over 2% per year with the money supply measured by M2 in
Yeah, there it is, by
Japan.
the way. This is the
Yeah,
Japanese money supply M2 growth rate.
very, very, very slow. And they have to accelerate that. They're only focused on interest rates, the Japanese, but they should be focusing on changes in the money supply. And this isn't something new. They've been doing this now for 30 years. Even yeah, 30 years, a little bit longer. Since the bubble popped in 1991 in Japan, they've had very slow, very tight monetary policy, and that tightness is indicated. The symptom of that is the slow growth in the money supply, and that's why the economy's been dead since 1991. It's not been growing, and the inflation hasn't occurred. In short, nominal GDP is doing just what we would predict as monetarists. That is, if you have very slow growth in the money supply, you're going to get very slow growth in nominal GDP, which includes nominal GDP is just the rate of growth in the real economy plus the rate of growth in inflation or prices.
I think people looking at this news and seeing the fact that the U.S. hasn't done a yen intervention since 1998, since the 1997 Asian financial crisis, that has worried some people and caused people to wonder whether or not this is the beginning of perhaps another Asian financial crisis. And to answer that question, we have to examine what actually happened the first time and whether or not that experience perhaps led to the Japanese monetary policy that we see today. So walk us through, I know we don't have all day, but walk us through maybe what you know about how the Asian financial crisis started, and in particular focus on the mistakes that central banks in Southeast Asia made at the time, and then where you came in.
Okay, so the crisis actually started in July of 1997 with the collapse of the Thai baht, the Thailand's currency, and it collapsed. It was a classic case in which the baht had been kind of more or less pegged or loosely linked to the U.S. dollar. It was what's called a pegged exchange rate, and the central bank in Thailand had discretionary monetary policy. So they had two things at the same time. They had an exchange rate policy. They pegged the baht, and they had a monetary policy. So exchange rate policy and a monetary policy. And that's a deadly cocktail, by the way, if you have both of those things together. This happens all the time in developing countries. And what happened? To get at this, we have to look at what was going on with the balance sheet of the central bank. Now we get into the discretionary part. If you look at the liability side of the central bank, that's where you find the monetary base. The so-called monetary liabilities are on the liability side. Now, to match those, the assets, you've got two kinds of assets. You've got foreign exchange assets, and you've got domestic assets, domestic bonds that are dominated in baht in this example. So what had happened, the foreign exchange reserves, that part on the asset side of the balance sheet, that was going down, down, down. And to keep the money supply goosed, discretionary monetary policy was being used by the central bank, and they were buying Thai baht bonds, domestic assets. So you had the foreign exchange assets going down, but the domestic assets were going up. In other words, you were in a way swapping foreign assets for domestic assets, and that got them into trouble because that meant, of course, the quality of the monetary liabilities was going down because they had the proportion of foreign assets covering those liabilities was going down, 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 and the domestic BAT assets was going up, up, up. And you had a classic case of the thing blew up.
How did the Thai baht blow up, ripple into the other Southeast Asian countries?
Okay, then everybody started the baht collapse. Everybody started looking at other currencies in the region, and one currency that they looked at big time. They looked at all of them: the Malaysian ringgit, the Indonesian rupiah, the Indian rupee, and so forth. Everything, but kind of the one epicenter, big epicenter of the thing, was the Indonesian rupiah, and it came under tremendous selling. It was also pegged just like the baht to the U.S. dollar. And Bank of Indonesia had discretionary monetary policy exactly like the central bank in Thailand. Mm-hmm. So once the shorts started piling into the rupiah in Indonesia, the foreign exchange goes down, and the Bank Indonesia starts buying domestic rupiah denominated bonds. And so you had exactly the same kind of thing going on in the balance sheet of the Bank Indonesia as it was going on in the central bank in Thailand. And then, of course, what did Indonesia do? They called in the IMF for a rescue. And the IMF doesn't put out fires, it starts fires. And when they called in the IMF for a rescue, the IMF, the first thing they recommended, they say, oh, you've got to get rid of the peg, and you've got to let the Indonesian rupiah float. And when that happens, you then have a situation where, yes, you have monetary policy, discretionary monetary policy, but you don't have an exchange rate policy. You're letting the free market determine what that rate is in the float. So you don't have the deadly cocktail anymore. Okay? And they start floating. Well, what happened with the float, the rupiah didn't float on a sea of tranquility. It collapsed. It totally collapsed. And what happened then? Then you had, especially food prices, but all prices, particularly food though, went shooting up. And you started having food riots in Jakarta, and tremendous protest against who? President Suharto was the president at the time. He was running the show literally, in every aspect of the economy and the governance and so forth. And in January, Suharto obviously had been advised that earlier in 1997, I'd just done two big currency reforms that rescued Bulgaria in 1997. I was President Suharto's chief advisor. The inflation rate was 242% a month in Bulgaria. And we did have a viewer, by the way, that was in Bulgaria at the time and observed that he knew very well what I did in Bulgaria. And that is, I saved Bulgaria and I saved the Bulgarian lev by installing a currency board system in which the lev was issued, but it was by the Bulgarian National Bank in a currency board arrangement. And that lev traded at a fixed exchange rate with the German mark, and it was backed up 100% with German mark reserves. So the lev became in July of 1997, a clone of the mighty German mark. And that hyperinflation of 242% a month disappeared immediately. The banks became insolvent immediately. Growth started immediately. The fiscal deficit turned into a surplus immediately, and it was a roaring success. Then in August of 1997, I helped introduce the currency board in Bosnia Herzegovina, which again the marca, the Bosnia Herzegovina marca was issued, and it was like Bulgaria, fixed at a fixed exchange rate with a German mark, fully backed by German mark reserves, and that particular instance of the installation of the currency board was interesting because it was mandated that in the first 6 years of the independent Bosnia-Herzegovina, they must have a currency board. And that came from work that was part of the Dayton Agreement. And that came from actually a book that Dr. Kurt Schuler and I wrote, and that was published in Serbo-Croatian in Belgrade. So that the people in the region knew about this. It was in there. The book was in their language. At that time, I'd been an advisor to the old Yugoslav government before the Civil War started and the breakup of Yugoslavia. But at any rate, that was very successful. And we're back to Suharto in January. He'd been advised about this, and he said he'd been told, you better get a second opinion from Hanke. Forget the IMF. You better get a second opinion from Hanke.
Why did they contact you in particular?
Well, because I'd just done Bulgaria and Bosnia. Everyone knew about it. Okay. So, and they knew that it stabilized the currency, stabilized the country, turned everything around in a positive direction, and that's just what Suharto wanted, because the IMF had thrown him into chaos by recommending that they float the currency. Now, by the way, with a currency board like Bosnia and Bulgaria, there is no monetary policy. The balance sheet of the central bank the only thing that moves on the asset side of the balance sheet is foreign exchange. The foreign exchange moves up and down, and the monetary liabilities move up and down in accordance with the movement of the foreign exchange. But there is an exchange rate policy. The domestic currency is fixed to the anchor, but there is no monetary policy. There's no discretionary monetary policy. So you can't get into one of these problems like Thailand, where you have a monetary policy and you had an exchange rate policy, this pegged exchange rate policy, and eventually those two things end up, it's a deadly cocktail, and they get their feet tangled up because you got monetary policy that's in conflict with the exchange rate policy.
Yeah.
That's why the Thai baht blew up.
Last time you told me that, sorry, please go ahead.
So at any rate, we're to January, and actually, Mrs. Hanke and I were in Istanbul at that time when Suharto's chief of staff contacted me, and they wanted us to go to Jakarta. And I said, well, when? And they said, tomorrow. I said, you must be kidding. I said, not only I've got an agenda in Istanbul, but I have to return to the United States to testify before the U.S. Congress on precisely exchange rates and precisely what I'd done in Bulgaria and Bosnia. So they said, fine, as soon as you get done with that testimony, get on the plane and you get out here as fast as you can. So I did. And I met Suharto and explained what I thought should be done, how it worked in Bulgaria, how it worked in Bosnia. And our first meeting, then the key point, he said, well, fine, I understand. And he said, I'd like to appoint you then as my chief advisor. And I said, that'd be fine. I said, I'll accept that, but I always do these assignments pro bono with no consulting fee. And so he looked at me with a strange look, and then he asked again what my terms were, and I repeated, and he said, well, I understand, and you're appointed. And then he announced the appointment, and the rupiah actually in one day on the spot market in Jakarta and the 1 year forward market in Singapore, the rupiah appreciated just on the announcement of my appointment. It appreciated 25% in one day. One of the great. It was not a dead cat bounce, by the way. It was a huge rally, and the 1 year forward was the most important rate that I watched, because that meant that people thought that I would install a currency board, and whatever the exchange rate was that we ultimately determined, it would be sustained. And it would certainly last a year, because they were betting on the 1 year forward. So what happened next? I designed the thing, I drafted the law and so forth, and Mrs. Hanke and I were in residence at the Shangri-La Hotel in Jakarta, and I was meeting with Suharto, and I became, as they said, I was one of the cronies. I was meeting with Suharto every night at his residence, his little den, and we were strategizing on what we were going to do, and he announced that he was going to do the currency board, and when he announced that, all hell broke loose, because the U.S., and led by the United States, and the kind of bag man for the United States was the IMF. They were opposed to the currency board, violently opposed to it. And Clinton, in 3 telephone conversations with Suharto that I was listening in on, he kept repeating. Clinton said, if you do Professor Hanke's currency board, you're not going to get the $43 billion bailout from the IMF and the U.S. And Suharto ignored that and said, we're going to do it anyway, because he knew it would stabilize things, and he knew that stability might not be everything, but everything was nothing without stability. And then in May, all of a sudden, Suharto called the whole thing off, because the U.S. sent about half of its Pacific fleet down to do exercises off the coast at Jakarta in Indonesia, and the military got spooked. The Indonesian military got spooked, and they spooked Suharto, and he dropped the idea of a currency board, and the chaos continued, and then ultimately, shortly thereafter, he was forced to resign.
Yeah. So basically, the U.S. forced him to drop this through military force. Okay, I'm glad I got your side of the story, which I want to expand on further, because this is the IMF side of the story. I was looking this up earlier, and this was a paper written by the IMF in 2003, and basically it cited your currency board idea, and it explained why it wasn't adopted. It sums up to a few reasons. Basically, they thought the exchange rate was too aggressive. They thought the country lacked sufficient reserves.
Number one, I know this thing. It's got 115 references in it, and they don't even cite any of my technical papers or anything.
Let me just read to you this paragraph, and you can tell us what's wrong with this, okay? Monetary policy presents one of the clearest examples of the absence of singleness of purpose. In early 1998, Suharto and some of his advisors saw merit in the introduction of a currency board regime. Although the proposal was seriously evaluated by the IMF, it was opposed on the grounds that a currency board, which prevents the central bank from acting as a lender of last resort, was inconsistent with the blanket deposit guarantee that had helped stabilize the financial system. Given the fragility of the economy, a currency board at the level reportedly being considered by the authorities would not have been credible, as it would have entailed extremely high interest rates. Moreover, it would have benefited only those well-connected individuals who could have converted the rupiah into hard currency before foreign reserves were fully depleted. With this debate carried out in full public view, it caused considerable confusion and once again weakened the ability of monetary policy to stabilize the exchange rate.
Okay, point number one, the deposit insurance, this whole paragraph is absolute trash. And the deposit rate guarantee, did that stabilize the banking system? The IMF advised to float the rupiah through the whole country, including the banking system, into a complete state of crisis. The IMF policies created a huge crisis. And by the way, the lender of last resort with the currency board system, the monetary authority cannot make loans and perform lender of last resort functions. But the fiscal authorities can. You can do it out of the fiscal budget, which they so they don't even understand how the system works. Number two, the level of the exchange rate. There was a famous interview with me. It was in the International Herald Tribune. Stevens Broning was the editor in Paris at the time, and he interviewed me in Paris. And we went through this phony charge that I had somehow was going to set the rate of either 5,000 rupiah or some said 5,500 rupiah.
That's right.
That never occurred. I never decided that. I was going to do it and this interview is called An Interview with Suharto's Rupiah Guru. An interview.
So the reported number was Suharto was considering a peg around 5,000 rupiah per dollar. That's not right.
Not true. It's not true. I never recommended the level. And let me tell you what I did recommend, which is in the interview published in the International Herald Tribune in 1998. The author, the interviewer, was the editor-in-chief, Stevens Broning, and I made it very clear that I would do exactly what I did in Bulgaria. We would announce the currency board was going to be introduced, and the central bank would there terminate any monetary policy. They would freeze the monetary base, okay? And they would let the domestic currency float for 30 days, and then we would determine, after observing what was going on with the floating exchange rate for 30 days, after 30 days, we determined what the fixed rate would be. So there was never a proposal for 5,500. That was a phony thing that was leaked by opponents of the currency board system. That was never. I was the chief advisor. I was the one who drafted the law, and those numbers do not appear in any document. So that's just a lie. That's just a fabrication. The first thing about the deposit thing, the IMF just doesn't understand how it works. So they're just ignorant and don't know. The level of the exchange rate was a pure lie. The high inflation rate is a stupid argument. When you put in currency boards, the interest rates go down. The interest rate in Bulgaria, by the way, 1 year after we put in the currency board, was what? The money market rate was 2%. 1 year after we installed the thing, it was 2%, the money market rate.
Right.
And then one reason that they put the phony exchange rate in, they had a narrative. They said that Suharto and all these cronies would take the money and run, and they would get all their money out of rupiah into U.S. dollars at a very favorable exchange rate. The problem with that argument is, number one, as I said, the exchange rate was a lie anyway. But as a practical matter, the cronies and Suharto owned things like turnpikes, toll roads. What were they going to do? Roll the toll roads up and take them out of Indonesia? I mean, it was the stupidest thing. But it caught on. And the journalists, of course, you can't underestimate the stupidity of journalists and their ignorance about these things. They bought the story. So
Uh,
it was all a story to keep the financial crisis going, and do what? Get rid of Suharto, which ultimately they did.
there were several reasons for this. By the way, the IMF themselves stated in another paper that perhaps they didn't say outright the currency board would work, but perhaps if it had worked, that the Suharto regime would bypass several reforms that the IMF required him to make. Basically, he would stabilize the currency without having to implement IMF imposed reforms, because the IMF and the Clinton administration wanted structural reforms, not just a stable currency. Does that make
Okay,
sense?
yeah. Well, let's point out what I recommended and what Suharto agreed to in his
Yeah.
state of the state speech, and that is, I said we're not going to just do to get the IMF off our back and actually make these structural reforms easy to do. We're going to do the currency board, okay? And what we're going to call this whole package, we're going to call it IMF Plus. If you look up IMF Plus, that was we do the currency board plus everything that the IMF wanted Indonesia to do. That was our plan. IMF Plus. And the plus was the currency board. So
Well, somebody,
even that's a lie. You see, every one of these things, since I was there and I was with Suharto every night, I know exactly what was going on. Of course, the IMF didn't. It actually sent a special advisor out to meet with me while I was in Indonesia. And the special advisor, of course, was completely clueless. He didn't even know there was a 1 year forward market on the rupiah in Singapore.
well, regardless of whether or not Suharto agreed to the reforms, somebody in Washington didn't trust him enough to actually implement the currency board. Here's another paragraph. I'm just giving you more fodder here. This is from the IMF, same paper, second paragraph. Recent performance of the Indonesian economy and remaining challenges. Again, this was dated June 2003. Assessing performance as of June 2003, the exchange rate has appreciated considerably to near 8,000 rupiah per US dollar. Inflation is back to single digits, under 7% in June, and interest rates have declined sharply from near 18% in December 2001 to roughly 9% today. Major progress has also been made towards restoring a healthy and sustainable budget position. As a result of this success, and helped by the appreciation of the rupiah, Indonesia's public debt burden declined by roughly 20 percentage points to 83% of GDP between 2000 and 2002. It goes on and on. Basically, whatever the IMF package did worked, according to this.
Of course, they're patting themselves on the back. You said 2000 to 2002. The crisis was in 1997 and 98. So they don't tell you about the crisis they created in 1997 and 1998. They don't tell you about that. The rupiah, by the way, it did appreciate because at the low it was around 16,000. So
Yeah.
the number they gave, and when they did this report in 2003, it had already appreciated a lot. It was back up to about 8,000. Now it's back down. Today, I don't know what it is today. I really haven't looked it up, but
Mhm.
it's lost a lot of value.
Right.
So
Well, I mean, there was.
this is all BS. These reports. It's very interesting to take them apart because read another paragraph and let me destroy that, please.
Uh, maybe I'll read a comment first. I'm watching from Jakarta. This is from our last video. Yes, Professor Hanke, we have had a bad experience with IMF and foreign intervention. So, for any other Indonesian viewers out there, or people who have lived in Indonesia at the time, comment below what your personal experience has been. We'd like to know. But what do you think why do you think the locals have had a bad experience with the IMF and foreign intervention?
Well, the IMF was intervening. They were doing Clinton's dirty work. The Kem Desu, when he retired, he was a managing director of the IMF at the time that this happened. And when Kem Desu retired, in his retirement speech, he said one of the great things they accomplished is getting rid of Suharto. He said that in his retirement speech. Look it up.
Yeah.
So the IMF, their job was to get rid of Suharto. And how were they going to do that? They were going to do it by creating one hell of a crisis that took him out. And they did. Now Clinton, of course, was the guy really behind the king on the throne was Clinton. This was a Clinton operation. And Clinton wanted to get rid of him because the Clinton campaign had taken a considerable amount of money from China. The communist Chinese had contributed to Clinton's re-election campaign, and that money had gone through a bank in Jakarta. It went from China to Indonesia to the United States, and Suharto being Suharto and being an autocrat, a dictator, if you will, he was fully aware of this, and Clinton knew that he knew. Why do you think Clinton was so obsessed with getting rid of Suharto? He was obsessed because he knew that Suharto knew something that Clinton didn't want anyone to know. And subsequently, by the way, a lot of this has come out because some of those people that were facilitating the money transfer were actually convicted. So we're not talking about hypotheticals in a classroom here. We're talking about the real world.
Yeah. By the way, this was from the IMF library here. Detailed assessment of the role of the IMF in Indonesia's capital crisis of 1997 to 98. In regards to the currency board, this is what it says. With the currency in virtual freefall from December through January, even after the signing of the revised LOI, both the IMF and President Suharto independently began to consider introducing a currency board arrangement. In Indonesia, business interests close to the president initiated the idea and invited an American academic expert to advise on the subject. That was you. The idea of formally introducing a currency board was declared by the president in February 1980. We talked about that. There was widespread, though unsubstantiated, concern, including within the IMF, that if the CBA were adopted, the rate would be 5,000 rupiah per dollar, around half the going market rate, and that its supporters would use it to convert their rupiah holdings into U.S. dollars.
That's the narrative. That's the fiction that the IMF put out. Now, notice how they dealt with me. They never even mentioned my name. That's the IMF. These people talk about dirty tricks. This was a huge black mark on the IMF, by the way, a completely indefensible thing. And just to top it off, to give you something else to put in your hat.
Yeah.
In December of 1997, there actually was a secret meeting at the IMF in which the IMF was trying to convince Brazil to put in a currency board. And they met with the Minister of Finance secretly. The Brazilians didn't want to do it. But that was before I was even called in. Remember the sequence. I did Bulgaria in July of 97. I did Bosnia in August of 97. And in December of 97, secretly, the IMF bigwigs met with the Minister of Finance and other high authorities from Brazil, trying to talk them into doing a currency board. So all of this is just BS. Now, what happened in 1998? Let's go a little forward. Let's jump forward. And also in February, right before Mrs. Hanke and I went to Istanbul and received that telephone call from Jakarta from Suharto's staff, we were in Vienna, and I was giving a speech, and during the speech, I was talking about exchange rates. This was in February of 1997, and during the speech, I was talking quite a bit about the ruble, and the ruble had one of these pegged exchange rates, just like Thailand. Remember, we were talking about Thailand, where they had a monetary policy and they had an exchange rate policy. The exchange rate was to try to keep the ruble linked loosely with the U.S. dollar, and then they had a monetary policy. During my speech, I went through the balance sheet of the Russian central bank, and I said, "Look, the foreign exchange is going down like a stone." And are we frozen, David?
No, no, I still see you.
Okay, so I said the foreign exchange was falling like a stone, and the net domestic assets denominated in rubles was going up very fast. So the quality of the assets backing the ruble liabilities was deteriorating badly, and I said, I think the ruble's going to blow up. This was in February of actually, excuse me, February of 1998. February of 1998.
It is.
And what happened? I noticed there was a Reuters reporter at that meeting in Vienna, and he put out a story, and he said, "Well, Hanke indicated that the foreign exchange was falling like a stone, the net domestic assets were surging, and he thought the ruble would collapse." And when that hit the wire, hit the street, the ruble depreciated 3% against the U.S. dollar, and right away I put a short position on the ruble. And what happened? On August 17th of 1998, the ruble collapsed, and we had a second crisis in 1998. The first one was the Asian financial crisis, but don't forget the ruble crisis started in August of 1998. And that's when long-term capital, remember, they went bust then. One of the biggest hedge fund crack-ups we've had in history, long-term capital, that happened. So all this was happening at the same time. A lot of things were happening at the same time. None of them comport at all with the lies put out in those IMF reports. They're all lies. They're just making it up.
Well, decades later, this IMF report in 2025 last year, I mean, I don't think they never admitted, well, they did admit that it worked, that the currency board in Bulgaria, but this particular paper examined the Bulgaria financial crisis and the subsequent impact of the currency board, and they admitted that it worked. Let me just read. The economy began to stabilize following the currency board announcement in March of that year. Inflation fell to 22% by 1998, and interest rates dropped as well. Going a little bit earlier into the article here, the opposition came into power. The weakest banks have been closed and public debt inflated away. The new government was ready to take a key step to stabilize inflation and support long-term credibility and financial stability, creation of a currency board. So, the IMF they admit that the currency board works. They never opposed that idea. It's just that after 1997, no new currency boards were instituted.
No. Let me correct that. They opposed it initially. They finally got on board when the government of Bulgaria said we're going to do it. Then the IMF got on board, and the reason they got on board, it wasn't from headquarters in Washington, D.C. It was the European director of the IMF, who I happened to explain what was going on, what we were going to do. He got on board. So the European division of the IMF, European department, as they call it, they got on board, and then the IMF changed its tune. And I can report, ever since the currency board was established in Bulgaria, all the so-called Article 4 reports, that's these ex post evaluations that the IMF does. The technical people do these. And they've been given glowing reports, every single one. You can't find an Article 4 IMF report that's ever been produced since the currency board was put in that wasn't glowing about how great the currency board had performed.
So if nobody denied the positive impact of a currency board on Bulgaria, why weren't any currency boards implemented after 97? To my understanding, that was the last one, correct?
That's correct. And the main reason is that the religion at the IMF is that they like an independent central bank with discretionary monetary policy. And that's the template. That's the IMF template. Currency boards are not in the template. So in principle, at kind of a theoretical level, they're against currency boards. And they try to undermine any proposal to have a currency board. And they do this by the staff. The staff of the IMF goes in and they try to whisper in the ear of any finance minister who's considering, or any president or prime minister who's considering a currency board, not to do it because the IMF will reject it. But that is illegal, actually. They're not supposed to be doing that. They're leaking this information. What is legal is the articles of the IMF, the constitution of the IMF. It indicates that the IMF must consider in good faith any exchange rate and currency regime that is being proposed to it by a member state. And then after it's being proposed, they will evaluate it and come up with an opinion. And the board of the IMF will either approve or disapprove. But what you have is the staff, the little research staff people front running these things and trying to sabotage them. So that's why you haven't seen it.
Okay.
Now, that's what they tried to do in Bulgaria, by the way, but the director of the European department put a stop to that.
Let's suppose the Tokyo government calls you tomorrow and says, look, our yen is depreciating. We're not at an Indonesia level yet, right? Remember, the rupiah collapsed 85% in 97, 98. But our yen is depreciating. We have a problem. What do we do? What do you tell them?
Well, I'd say they have an option. They could do a currency board and have an exchange rate policy with a fixed yen, and the yen be backed fully by U.S. dollar. Trades at a fixed exchange. They could do that, or alternatively, there's enough. That's one free market mechanism. The other one, I would say, you could have no exchange rate policy. You could float the yen and have a central bank and follow a quantity theory of money approach, a monetarist rule for the rate of growth in the money supply, which would be around 6% a year. I said it's a little over 2% now. It should be growing at about 6% per year. That's the rate of growth in the money supply consistent with hitting its inflation target of 2%. So I tell them, you have two free market ways to do things. You can have a floating exchange rate and a central bank with discretion and abide by the quantity theory of money and a monetary growth rule, or you can have no monetary policy and only an exchange rate policy and have a currency board.
Why do you think monetarism was more influential in the 70s and 80s than it is now? Like you said, several central banks have omitted this.
I think the main reason that it was is that you had Milton Friedman was the leader of the monetarist and quantity theory of money approach, and he was very influential.
Okay,
maybe more influential in the United Kingdom than in the United States, but he was very influential. And he was the leader of the quantity theory of money, the biggest advocate of the quantity theory of money.
And this is getting theoretical here, but I think from what I've read, the problem today is that nobody can really accurately define what money is anymore. So when we're talking about controlling the money supply, there's a debate as to what actually is being controlled, correct?
Well, that's the argument, but it's a phony argument. You can measure it very accurately at the Center for Financial Stability, where I'm a senior counselor, and where you've got the William A. Barnett, the greatest guru in measuring money. He's the dean in this area. They measure Divisia, that's the right index, and they go all the way out to M4. They got M2, M3, M4. So they measure all of those things. And where does the Fed? They don't use divisia. They use simple sum measures, which are inferior, I think, to divisia measures. Point number one. And they don't measure money very broadly. They only measure it. M2 is the broadest measure they have. They stopped even producing M3 numbers in 2006. And the reason they did that is that they don't pay any attention to the money supply. The reason they don't measure it properly, they don't care. They claim that money doesn't have
Right.
any reliable connection with changes in economic activity. That's the Fed.
Okay, so going back to the Asian financial crisis, how come Hong Kong survived and Indonesia and Thailand didn't?
That's a very good question. That is the key question. Hong Kong, as of 1983, my colleague John Greenwood was the architect of reinstituting the currency board in Hong Kong. So the Hong Kong Monetary Authority has a currency board unit within it, and the Hong Kong dollar is fixed to the US dollar. It trades at a fixed exchange rate. It is fully backed by US dollar reserves, and the Hong Kong dollar is equivalent, a clone of the US dollar. And they had no problem.
Mm-hmm.
And they have
Yeah.
no problem. Hong Kong was the only place in Asia that that survived the crisis intact.
And so when Soros tried to short Asian currencies, just mechanically speaking, can you explain to us how Hong Kong was able to survive such an attack
Well,
by a massive shorter?
Because Soros does not understand what a currency board is and how they work. The Soros people never understood it. And all these people, they think they can go in and short the Hong Kong dollar. It's impossible. It's impossible to blow up a currency board.
Why not?
Because they have reserves equal to 100% of the domestic liabilities that they're issuing, the domestic money they're issuing. And at the extreme, let's take an extreme hypothetical case. Let's say everyone wanted to exchange their Hong Kong dollar at the fixed exchange rate with the US dollar. They could do that. And at the extreme, the whole economy would be dollarized. There wouldn't be any Hong Kong dollars. This would never happen, by the way, because if they started doing that, the interest rate fluctuates in Hong Kong and the interest rate would go up, and people would stop exchanging their Hong Kong dollars for US dollars because of arbitrage. They'd get a much higher interest rate in the Hong Kong dollar than the US dollar, and they'd stop exchanging. They'd stay in the Hong Kong dollar and get that premium interest rate over the US dollar rates. So the thing automatically would adjust. It would never go to the extreme. And it would never blow up. There has never been a currency board historically, David, that's ever blown up. There's never been one that's failed. That's the historical record. And Kurt Schuler and I are just in the process of finishing a large treatise on currency boards in which we analyze every single one that's ever existed. And I can report there are no failures.
They do require, like you said, the monetary authorities to hoard large numbers of U.S. treasuries in reserves. Do you think this hoarding, and not just with currency boards, but this experience overall that taught other countries around the world to hoard treasuries, do you think that this hoarding contributed to the large amount of debt that the U.S. currently has, and the creditor nation status that other countries have versus the U.S.?
First of all, you're just talking about currency boards. Currency boards don't hoard assets. They have 100% U.S. dollar, or in the case of some currency boards, you'd have the euro.
Yeah.
They don't hoard these things. They're interest earning assets, and
Okay.
they're issuing liabilities that pay no interest, but they have assets backing those monetary liabilities that are equal to 100% of the monetary liabilities earning interest. So they're profitable. That's another great point about a currency board. They're not hoard. You use the word hoarding like it's some bad thing to be hoarding something. No, they have assets equal to 100% of their monetary liabilities. Those assets earn interest. Their liabilities pay no interest. They make a profit. It's a good deal. The currency board's profitable. The currency board contributes to the revenues of the fiscal authorities.
Okay. I have a few more questions before we close off. I think we have to assume here going forward that Japan or any other country in its position wants to defend the yen. In the Asian financial crisis, Taiwan was an example where they initially tried to defend their currency. And as you may recall, at one point, I think in October, I was reading in October 97, the authorities decided to just let it depreciate. And that decision frightened some people because it indicated that even at the time, stronger Asian economies weren't willing to spend a limited number of reserves defending their currency. So at what point does a country make the decision to keep defending their currency and intervene, or just let it run?
Well, again, it's back to those two options that I gave you. You could stop pegging the interest, stop adopting a monetary regime approach in which you have a monetary policy with the central bank with a discretionary monetary policy and an exchange rate policy where you're pegging your currency to some other currency. What you have to have, you either have a floating exchange rate where you have no exchange rate policy, and that's combined with discretionary monetary policy with the central bank. That's one way to go. The other way to go, which would be probably a good idea in Taiwan, is you fix the exchange rate with a currency board and have no monetary policy.
Mm-hmm.
So you don't defend the currency with a currency board because there's nothing to defend. The currency you issue is a clone of the anchor, and it trades at a fixed exchange rate permanently with full convertibility to that anchor always. And
Right.
there have been never any failures. You never get a blow up like Thailand. You never get a Taiwan thing where the damn currency has a huge depreciation and you have to defend it. So if either with a floating currency board or a currency board with a fixed exchange rate to an anchor, you don't do any intervention to defend. Either one of those, they're both free market mechanisms, and there's no defense of anything. You get the defense in all these countries. Most of them, David, have actually a bad system that is potentially can end up in a crisis. And of course, people like Soros, by the way, know this because they attack the pegs. And the problem with Hong Kong and Soros keeps, he used to interpret the fixed exchange rate in Hong Kong as if, with the currency board, as if it's a pegged exchange rate with a central bank. And by the way, he was one of the big ones shorting the Russian ruble like I was, because he knew what I did. He knew the domestic assets on the balance sheet, on the asset side of the balance sheet, were increasing, and the foreign exchange assets were going down. That the domestic assets were replacing the foreign assets on the balance sheet. And once you figure that out, you short the thing.
Okay. Two final questions. So besides the yen, which you think is going to continue depreciating long term because of countries' fundamentals, what other countries' currencies do you think you would short today? If you just had to name one or two.
I'll think about it and tell you the next time we have an interview.
All right. Let's stay tuned for that. That's a good cliffhanger. Professor Hanke, by the way, for those of you who weren't aware, besides being an academic, was a very successful currency trader. We'll get his take next time. So, final question. Do you think, based on what you've observed today, there is going to be a repeat of another Asian financial crisis? Is that why Scott Bessent and his friends, not friends, but his partners are worried about what's happening in Japan?
I think that's a narrative that's going around to kind of justify what they're doing. They're basically saying, "Oh, look, the doctor has gone in to administer a prescription to the patient because we think the patient is sick." I'm not so certain that holds much water. Actually, I think that's just a justification for what they're doing. I don't see any particular crisis coming up on the horizon, but again, sometimes it's hard to predict one. In Russia in 1998, I predicted the thing perfectly, but sometimes this is hard to do. And right now, there's just nothing screaming that it's about ready to blow up. And in fact, by the way, the Thai baht thing, that very few people predicted that.
Well, once it unravels, it goes full steam. Thank you so much, Professor Hanke. Again, please write to us. I'll put our emails down below. If you have any questions or topics you'd like us to comment, and of course, comment down below what you'd like us to cover next. We did this session because a lot of people requested it. So thank you very much, Professor Hanke. Where else can we follow you and read your work?
You can follow me on X at Steve_Hanke, or David. They can just send me an email if they want to be on my weekly distribution list. That email is Hanke at jhu.edu.
Correct. All right. Thank you. We'll put the links down below and Hanke's email. Thank you so much, Professor Hanke. We'll speak to you next time and talk about currencies and current events. Thank you.
Okay. That's great, David.
Thank you for watching. Please do like and subscribe and follow Professor Hanke. Links down below.